Trend lines can be truly effective methods for trading, though many people misuse them quite often. Wrong. The most confusing part about trading trend lines is that every trader seems to draw them differently. Take this chart for example. Some traders might prefer to draw the trend line connecting the wicks of the candles, while others might prefer to draw it connecting the bodies of the candles. So which one is correct? Now, even if we figured out how to draw them, the next big question is, how do we actually trade them? Should we wait for the price to touch the trend line and enter by anticipating a bounce? Or should we wait for the price to break the trend line anticipating a trend reversal to short it? The truth is, I've tried all of these approaches, but throughout my trading career I've discovered the best way to trade trend lines, which to this day have made me a lot of profit. So in this video I'll reveal the best strategy for trading trend lines, including an in-depth tutorial on how to actually draw them properly on your chart. And by the way, I created a free guide that compiles all the trend line strategies from this video into one document. Inside you'll get a step-by-step blueprint on how to trade these strategies, which you can just easily follow for your next trade. To access this guide, you can grab it inside my free Telegram community. Links in the description. Now let's dive into the video. First, what is a trend line? A trend line is a straight line drawn on a chart that connects two or more swing points in price. Let's look at an example. In this chart we can see that price is fluctuating, moving up and down repeatedly. So with all these movements happening, how can we tell where the market is actually heading? Simple. We draw a trend line by drawing a straight line connecting the swing lows on the chart. We can see that the trend line is heading in an upward slope. This tells us that despite these short-term fluctuations in price, the overall market trend is up. Now let's look at the opposite scenario. Here's another chart. Again, we can see that price is fluctuating, moving both up and down. However, when we apply a trend line this time connecting the swing highs, we can see that the trend line is sloping downwards, meaning that despite the short-term fluctuations, the overall market trend is down. Now a question you might be asking is, can't we already tell where the overall market is heading just by looking at it? Why do we even need trend lines? The answer is simple. Trend lines do more than just show the trend. They also help us spot trade setups we otherwise wouldn't have spotted if we looked at the charts with the naked eye. For example, in this chart we've applied a trend line by connecting the swing lows. Now notice that in the past, price tends to bounce off the trend line every time it touches it. This tells us that in the future, if price ever approaches the trend line again, there's a high probability that we can expect another bounce. So a possible trade setup here would be to take a buy trade if price retraces to the trend line. Now the second reason why trend lines are useful is that if price breaks a trend line, it could signal a possible change in trend direction. For example, in this chart we've applied a trend line by connecting the swing highs, and it clearly shows that the market is in the downtrend. But right here, price broke above the trend line, and soon after the trend shifts from a downtrend to an uptrend. Knowing this, the next time price breaks out of a trend line during the downtrend, we could set up a possible buy trade. But keep in mind, the examples I showed you are just ideal scenarios. In real trading, we can't just blindly enter a trade every time price touches or breaks a trend line, because these you don't need to stress about using indicators. You can simply draw basic trend line. You can earn profits if it's done correctly. Let's begin by covering the simple parts. A trend line joins a minimum of 2 points. It helps you understand the market trend. Assume the price creates a recent high, then it drops and reaches a higher top. You could now draw a proper trend line. It connects all of these rising bottoms. This gives a clue that price is rising. In a strong uptrend, prices push higher. This pattern repeats many times. In each case, trend lines work well. The key is to draw through exact lows. The line should connect real market dips. Avoid forcing lines through false areas. Try drawing through solid, obvious lows. Don't include shadows or spikes here. Focus on connecting body to body only. You'll get more accuracy that way. Trend lines need to be as clear as possible. A clean chart gives better insight fast. Don't clutter the chart with many lines. Keep things simple and easy to read. The cleaner it is, the better results. Try checking how the market reacts often. Look how price behaves near your line. Sometimes, price will bounce off strongly. Other times it may break right through. You should prepare for both situations. Trading isn't always a clear path. You must be flexible with your plan. The market won't follow your wishes It moves based on countless inputs, but your strategy can still adapt. A strong trend line improves planning. Use it to guide your trade entries. It's helpful for setting your stop loss. Stops should sit beneath the line. Give the market space to move naturally. Tight stops might get hit too early. Let your trade have breathing room. Now let's move to the next concept. We'll now talk about resistance levels. Resistance marks a ceiling for price. Price often fails to rise above it. You'll see multiple touches sometimes. That's when it becomes strong resistance. It tells you price struggles at that zone. You can draw a line across the peaks. It connects points where price reversed. This helps identify the price ceiling. The more touches, the stronger it gets. It can signal where selling might begin. Watch closely when price approaches it. You might see rejection happen fast. That gives clues for your trade setup. Sometimes price breaks through strongly. That's when you confirm a breakout trade. You could enter as price moves past it, or wait for a retest of that line. Retests often confirm strong breakouts. It reduces chances of a false entry. You'll want confirmation before entering. Candlestick patterns help with that. Watch for wicks or rejection candles. They hint at where price may reverse. It's all about waiting for right signals. Never rush into a breakout setup. Let the market show its real intention. Now, let's shift to support zones. Support works like a floor for price. It's where price tends to bounce back. Draw it through repeated low points. Each touch confirms the zone's power. Traders buy near this zone repeatedly. It reflects strong interest from buyers. Again, look for signs of price reversal. Reversal candles signal potential entry. Don't forget to check higher time frames. They help confirm strong support zones. Multiple rejections build strong trust. This gives you more confidence to trade. If support breaks, be cautious quickly. The break might start a bearish phase. Don't stick to losing trades for long. Cut losses fast to protect your funds. Support turns into new resistance often. That's called a role reversal in trading. Same applies when resistance becomes support. The roles flip after a confirmed breakout. This happens in trending markets usually. So always watch how price reacts there. Use these flips as trading opportunities, but only after getting solid confirmation. Let the candles prove the trend shift. If not sure, wait for the next move. There's no harm in skipping a setup. Safe trades are better than fast ones. It's better to wait than to lose money. Stay patient and protect your capital. If your setup isn't clear, hold on. Only act when things line up well. You must trust your analysis fully. Don't let emotions control your trade. Use logic when choosing your entries. A rushed entry often leads to losses. Wait for the signal that fits your rules. That's how good traders stay consistent. Now, let's talk about trend channels. They show price swinging in a range. It's like the market's own boundaries. Price moves between two parallel lines. The top line marks resistance levels. The lower one shows where support lies. They help guide entries and exits. Buy near the base, sell near the top. But always check if the trend holds. If price breaks, the channel weakens, then you may need to switch your bias. Retesting the edge confirms the break. Volume spikes help you confirm that. More volume means stronger conviction. You want trades with strong follow-through. Weak moves often reverse quickly. So study the strength behind the move. Don't just trade because it looks nice. Have proof before pulling the trigger. Next, we'll examine how trends begin. Most trends start after a breakout. That break must come with solid volume. Volume gives weight to the direction. Without it, a move lacks strength. Big players push volume into markets. You follow where that pressure goes. Don't fight momentum, flow with it. Your goal is to catch the wave early, and then ride it with a stop in place. Stops protect you when trends reverse. No plan is safe without risk control. Let's look at examples of trend trades. Here's one with a perfect entry spot. See how the candle closes above resistance. That's our green light to jump in. Set your stop right below the zone. Aim for reward that's at least double. Risk to reward must always make sense. Don't chase trades with poor reward. Keep your strategy tight and clear. Now watch what happens after entry. Price moves up quickly with strength. That shows strong momentum behind it. Always let winners run, if possible. Lot profits once target nears. Trailing stops help secure gains too. They move up as price rises, so profits stay safe automatically. That removes the stress of watching. It's a hands-off way to manage trades. If price turns, you're already out. It limits losses and locks in profits. This way, you stay calm and focused. Let the system handle the rest for you. Next, we'll check a failed breakout. The price broke resistance but failed. That's a trap for impatient traders. They bought too early without proof. Smart ones waited and stayed safe. Always let confirmation lead your entry. See how the next candle reversed? That's a sign the break was weak. No follow-through, just a fake out. You must learn to spot these traps. False breakouts are common in markets. Stay sharp and study every setup. Look at volume and candle structure. That's how you judge the breakout strength. Don't just assume every break is real. Price action tells the full story. Read the chart, not your emotions. Now you've seen two different outcomes. Learn from both winning and losing trades. Both teach what patterns to trust and what signs to avoid next time. This practice builds real experience. You'll know what works in each market because you've seen it happen live. Don't fear mistakes, learn from them. They're the best lessons you can get. Next, let's discuss trend reversals. Every trend eventually runs out. You must spot the early signs quickly. Look for lower highs or higher lows. That hints at a change in direction. Watch volume shrink near the top. Momentum fades before reversal hits. Next, price breaks its last support. That confirms the trend is done. Time to plan for a new direction. You can now switch your trading bias. Start looking for signs of the opposite trend. A strong reversal creates new opportunities. Don't hesitate when you see confirmation. Let price action guide your choices. Patterns tell the truth of the market. You just need to listen with your eyes. Now, let's break down pullbacks. They're like small pauses in big moves. The trend rests before pushing further. Smart traders use them to enter safely. You buy the dip when it aligns with trend. Just make sure it's not a reversal. Look for confluence before you act. Maybe a support line or key level. That adds weight to your decision. You're not just guessing anymore. You're aligning with solid logic. Pullbacks are tests of patience too. They trick impatient traders out. But the disciplined ones wait and win. Now, let's explore consolidation zones. These are periods of indecision. Buyers and sellers are equally matched. Price gets trapped in a narrow space, but that doesn't mean there's no action. Breakouts often come from these zones. A strong move out means something's changed. Volume usually confirms that breakout. No volume, then it could be a trap. You need evidence before committing. Always wait for the candle to close. Half signals only bring half results. Now we'll shift to managing trades. Good entries need good exits too. Have a plan before you jump in. Know when you'll take profit or stop. Don't guess, decide in advance. That keeps your emotions out of it. Trading becomes a game of discipline. You follow your rules no matter what. Let's see what a clean trade looks like. Perfect entry, smart stop. See how the price moves in your favor. You don't panic, you manage it calmly. Now let's review losing trades too. No system wins every time. Losses are just part of the game. The trick is keeping them small. Let winners grow, cut losers fast. That's how pros stay profitable. Let's wrap things up with key takeaways. Plan every trade before you place it. Stick to setups you truly trust. Only trade what you've tested. Use risk management every time. Don't over-leverage your positions. Protect your capital like it's gold. Because without it, there's no trading. Be patient and keep learning. The market always has something to teach. Even when you lose, you're gaining wisdom. So review your trades often. Find what works and repeat it. Avoid what fails and improve. That's how you evolve as a trader. Never stop growing your skill set, because the market always evolves too. Adapt or fall behind, it's that simple. Now, you have the knowledge. Use it. Go practice, test, and refine. The market rewards the prepared. So stay sharp and stay committed. You've got this, now go trade smart. When a trade doesn't work out, move on and focus on the next opportunity. Successful traders don't fear losses, they use losses to fine-tune their strategies. Now let's talk about timing your entries. The right timing can make all the difference. You want to catch the wave, not chase it. Let the market show you its hand first. Don't act on the first sign of movement. Wait for a strong candle to confirm. Confirmation gives you the green light. Let's not forget the power of trend lines. They aren't just lines, they're visual guides. They highlight momentum and structure. Price respects trend lines for a reason. It's where traders react and positions shift. Draw your lines with purpose. Don't clutter your chart with guesswork. Stick to meaningful highs and lows. Use touches, not just angles. And if for validation, adjust your strategy. Every broken line tells a new story, and stories build your trading experience. Final advice: keep it simple. Don't chase complexity. Master the basics. Simplicity leads to consistency, and consistency is what grows your account. Stick to your plan and trust the process. Keep records of every trade you make. Review them weekly and learn from them. Every win and loss has a lesson inside. Sharpen your skills like a craftsman. This is more than trading, it's a mindset. It's discipline, growth, and self-control. So be proud of every step you take. You're learning a powerful skill. A skill that can change your future. Now take what you've learned and apply it. The market's waiting. Are you ready? Trade smart, stay focused, and never stop learning.